Look, I'm really excited about today's guest. For those that don't know, it is Mike from, he's on Twitter known as Dividend Guy, and he's with us today. How are you doing, Mike?
Hey guys, thank you for having me. Actually, I'm a bit going to be disappointing because I don't drink this month. I'm on a dry month because I had too much over the holidays. but yeah, in general, actually, I kind of like the Heineken, which is a European beer. But yeah, because in Quebec we have like a bunch of micro breweries. So and those that like you mentioned like mangoes and something else European DGI. We have like one that is very good that is based with blueberries. Kind of sounds
Ah,
like a bit weird, but it's actually delicious. And in Quebec, they make like some heavy beer, like 6, 7, 8%.
wow,
So you don't
Nice.
want to have like 10 of them because yeah, you're gonna have a fun night.
Challenge accepted.
What's good to know, by the way, just for the dividend lovers, Heineken is paying lots of dividends. And just it's such a pity that they have like a payout policy of 40%, typical European. So I believe last year during the pandemic they cut their dividend again. So it's such a pity because why is Heineken not a dividend growth company, right? It belongs there. It should be there. It should be in everyone's portfolio. But somehow the Heineken family has another opinion. So maybe we should write a petition.
Yeah.
Yeah, but I was speaking off air. It could be the time to buy them because lockdowns and this COVID is starting to disappear. So Ireland today has announced that everything, all pubs, everything is back tomorrow from 6 a.m. in the morning. Pubs are back open and they will be full to the brim for the whole weekend. There's absolutely no doubt they'll be full all weekend.
Nice.
So Mike, do you want to just give our listeners, maybe some of them don't know who you are, just a brief introduction, maybe who you are, what you do, so they know you a little bit more.
Sure. I've worked as a private banker and certified financial planner for like 13 years. And then kind of got a fed up. And my wife was like, hey, how about we hop on a small motor home and do a road trip for a year? And I thought, yeah, that sounds like a good idea. So we jump on that motorhome with our three kids. They were 4, 7, 7, and 9 back then. Had a lot of fun. Drove all the way down to Costa Rica. Spent there 3 months living the pura vida. So that was like a lot of fun. And at the same time, I was building my membership website, Dividend Stocks Rocks. And I kind of realized that instead of helping like a few hundred clients at the bank, I could help thousands of investors instead online. So I've started building up that business while I was traveling. And when I get back home in 2017, I started working full time. And it's kind of funny because I had no safety net, no more savings besides like, retirement accounts. But like those, you want to keep them until you're 65. You don't want to start withdrawing them at 36, right? Doesn't make sense. So I started working very hard and then building that membership website, starting a podcast and so on. And basically just talk about dividend growth investing, especially in Canada and in the US. So I'm French Canadian by the accent, maybe you can tell. And yeah, so now we cover both countries. I don't know much about European stocks, so it's going to be an interesting conversation today.
You'll be surprised how many European stocks you will know. There's plenty of companies in your side of the world that
Yeah.
Unilever, for example, you would have heard of Unilever.
Yeah, of course. I mean, those big guys, we have heard of them, and I've looked at them like from time to time. One thing I have a hard time though is whenever we look at those because they trade on the New York Stock Exchange, we got all the numbers in US dollars. So if you're trying to find dividend growers, then you have to go back to their website because then like the dividend graph goes everywhere, like ups and downs every quarter.
Yeah, I noticed that as well because I do some writing for Sure Dividend, and I cover European stocks, but I have to do it in US dollars. And I noticed that it doesn't always show that they've grown their dividends, even though I know these companies did.
Yeah.
So I always have to go back and explain it's currency, it's fluctuation. So I completely get it. It's quite hard, but we're similar on the other side. We have to convert to USD, and it might not always increase in euro, but it will increase in
True
dollars.
that.
Yeah.
But it's really cool what you're saying, right? I think that many people in the dividend community kind of dream the life you've been living so far. So I think many people daydream about it, but are not doing it. And uh, tell me, what did you discover in that year when you were, let's say, traveling around? How do you look back at that? Was that like a life-changing moment as well?
Oh yeah, big time. Actually, it was really eye-opening on many aspects. First, our kids were young, so it was the perfect timing to spend 24 hours a day with them because they actually wanted to be with us. When they grow up to teenagers, it's sometimes not that that true. And the perspective of fear has completely changed as well. Before that, you want to have a good job, have a pension plan, and then you fear of losing your house or losing your job and what's going to happen. And then when you're about to cross the border of Honduras, where it's like in the top 5 of the most deadliest countries in the world, and you're driving in that country, so you're not spending time in Roatan like chilling on the beach, but you're actually going to see the real people, your perspective of fear is completely different all of a sudden. You have like the real fear that, oh, maybe I'm maybe bringing my family to their death or kidnapping or all those crazy stories we heard. So when I came back, I kind of realized that was life, just doing what you truly love, follow your passions. And I know it sounds very easy to say, and my parents and my in-laws, they were looking at me say, okay, but Mike, like, you must have like some savings, you must have like a cushion or a plan B. And I'm like, no, I'm just quitting my job, and actually I don't have enough money in my bank account right now to pay my mortgage at the end of the month, and that's fine. I don't fear that anymore. And I rather, during this trip, we were going back to sleep every night, and we were just like, damn, today was the best day of my life. Today was amazing. And then the next day, you just said, oh my God, today was also amazing. That's crazy. And then we went like volcano boarding. We went like offshore fishing. We learned how to surf. It was just like plenty of crazy adventure. And it helped like creating like this magical bonds with the family, with my wife. So yeah, I would definitely do it again. Actually, if it wasn't for my kids because they wanted to stay around with for school and family, my wife and I would have sold everything and continued just to travel. Because now, I mean, I've built.
Nice.
I'm not financially independent, but at the same time, I do what I want when I want, and I only need a laptop to make it happen. So that's the magic of this online
Nice.
business that you can create now.
Super.
Such an inspiring story, and you're right. A lot of people say this, but they never actually put it into action, and you've just seemed to run with it. How long did it take you? Like you must have had some fears beforehand. How long did it take you to make up your mind? Okay, that's it. I'm doing this.
Yeah, we actually, it took us 2 years to plan. I have this crazy habit of making life-changing decision within 15 seconds. So the real story was my wife had a daycare at home, and she was tired of like working from 7 in the morning up to 7 at night every day. So we were having a glass of wine on the terrace on a summertime, and she was like, "Hey, I read about that blog. There's a family traveling, but they were doing it with like bicycles." And I was like, "Okay, no way, I'm going to pedal up to Mexico. That sounds just crazy, especially with Greek kids." So let's talk about another plan, and then we talk about buying a motorhome. But I didn't speak Spanish, and most of our trip happened in Central America. I am zero with mechanic, like completely zero. And then I thought, okay, so now I need to buy a motorhome, understand how an RV works, and then if I've ever any problems, I have to figure it out. Like we didn't have any savings for that either. I mean, again, I could always withdraw from my retirement accounts, but then I would put my retirement plan at risk. So that was not necessarily a good thing. So we weren't afraid about a lot of things, but we just thought, you know what, let's put that aside and just use the good old trick. What if it's possible? How we would do it. So at first we had a house, for example. It's like, okay, so I cannot afford to pay that house. So we tried selling it, didn't work out, but we ended up renting the house for a full year. And that went very well. They paid the payment, and then that was solved, And then for every single thing, every single problem, we just thought, okay, let's just pretend it doesn't exist and just keep on moving about how we could make it work. instead of, it's pretty much the same thing when you're about to invest. There's always like a dozen good reason that 2022 is the year of the market crash and it's not the right time to invest. But that was true last year, 3 years ago, 5 years ago. It's always the same thing. So you have all those great reasons for not doing something. So we just put them aside and say, okay, let's figure out what we can figure out today, and we'll solve tomorrow's problem tomorrow.
I love it. I think I should ask my wife to call your wife one time.
For sure. Well, we have actually helped a few families to go after that, and I'm always open for this because it was just like the best time of my life ever. Like after that, I was 36 when I came back to Canada, and I said, there's a lot of things I want to do in life, but today I can die. Like I feel that I feel whole, I feel complete. Of course, you don't want to die at 36, but I was like, yeah, if it ever happens, I would still smile back at my life,
Yeah, nice.
And so, as an investor, were you investing back then, or was that on hold and you started when you came back from that?
All my investment are in retirement accounts. So they're all like in Canada, the way it works is they're tax sheltered. So as long as you keep them there, if you're making money from dividend or if you're making money from capital gains, you don't have to pay any taxes. So I had a pension plan with the bank that I was working with as well. So when I came back, I received that money because I quit, and then I could invest it. But it was like all not necessarily accessible money unless I have to pay a lot of taxes. And I start investing in dividend stocks in 2010 because I've been running like online gigs for a while, and at that time we were buying and selling personal finance blogs, and we ended up buying the Dividend Guy blog in 2010. And I thought, well, that sounds like an interesting strategy. Before that, I was like more like not a day trader, but almost. I was like trading like every week between 2003 and 2010. Worked very well, trading on margin and so on. But at one point, I was doing my MBA, I was having kids. I couldn't afford to spend 3, 4, 5 hours a day looking at the market on top of having my job and being a father and so on. So when I saw this blog, it was a great business opportunity, but then I kind of learned the benefit of focusing on dividend growth investing, which could let me beat the market most of the time. But at the same moment, it was not requiring me to like be scotched at my screen like 3, 4 hours a day. It was like, I can do that like with 3, 4 hours a year, every quarter, and that will be fine.
Yeah, I think it's kind of a luxury that people have in North America with retirement accounts. I know in Poland we have it a little bit here for a few thousand euros, let's say. I believe they started something in Netherlands, but it's not that common and definitely not with high numbers. And in general here, when you retire, you get a pension from the government, which is in most countries good enough to stay alive, let's say, and have a house and have food and these kinds of things. So I guess we contribute already so much on a monthly basis. I believe 10% of my salary goes every month into pension funds. So it's kind of the government is investing for me, which I hate because I believe I can invest in stocks that I like, and governments are also they're kept in check, so they need to invest in bonds a lot. Mm-hmm. So, for instance, I did one time an analysis in the Netherlands over the last decade. There was in total an accumulated inflation of 19%, but there was only 1% increase in future potential retirement income.
Yikes.
Yeah, so in a decade, we lost 18% on future benefits, let's say. And that's reality, yeah? So people are not necessarily empowered here when it comes to retirement savings. Shall we start a bit with the news of the week, actually? I think we forgot it, but that's no problem at all. But is there anything one of you saw in the news this week that you would like to talk about?
It was a quiet week, wasn't it? We only had Microsoft and Unilever to talk about. We talked about Microsoft first, didn't we? Because that was a pretty big announcement. I think they said that they want to acquire Activision Blizzard. Now, I don't know much about Activision apart from they used to show up on the screen when I used to play Call of Duty as a kid. That's as much as I know about the company. But you guys might know a little bit more.
I actually bought Activision Blizzard in December.
Wow.
And shared that with my member. And the thing is, well, they're a video game company and they have like a lot of popular games. Call of Duty is one of them, but they also behind Diablo, World of Warcraft, Candy Crush, if you're into mobile phones as well. And what happened is they went into a lot of problems and lawsuits because they had like some people that had like a bad culture of like harassment and then sexual misconduct, and part of like management knew about it, and that happened over last summertime in 2021. So the stock crashed, but like that is the impact of a few bad rotten apple in the business, but it has nothing to do with the thousands of other great employees that are working there and making great video games. So I was looking at that stock and I thought, you know what? Pays a very low dividend, but for the rest, the gaming industry is booming and it's going to continue, especially if we keep having those lockdowns. There's more and more people being hooked up on video games, and they have those great doors opening towards the metaverse as well, where they can create those games where you can like even like sell your guns on Call of Duty through NFTs, and then all those possibilities that are happening. They're not there yet, but those are like other growth vectors, and they have like hundreds of millions of players every month on those games. So this is like a great business at a cheap price. And then Microsoft came in and say, hey, how about we buy you up with some spare change, like 95 billions, I think. I know, $95, 68 billion.
68 billion, yeah.
Yeah, so I'm a Microsoft shareholder, and it's the probably all of you are, but it's the biggest position in my portfolio as well. And I was first wondering, like, why would they buy Activision Blizzard? But then I knew a bit about these stories, so I thought it's probably a value play for them as well. They can pay it almost out. No, they can pay it entirely out of their cash, right? So it's probably like pocket change in the end, a little bit there. And then I thought, like, it's actually quite a clever deal, because what Microsoft is also doing is with the cloud, all this data collection, all the insights that they are gathering. And if you look at their whole ecosystem, from that point of view, it could be a really good fit. I don't know. I don't hear a lot of people talking about that one, but I see there are a lot of options. But then also just like, with Xbox creating more monopoly there. And then on top of that, the metaverse. And if I learned one thing about Satya Nadella, he is a little bit like Buffett, right? He keeps like LinkedIn, there's companies, he keeps them still standalone, but he starts integrating in the whole suite. And I'm curious to see how he is going to do that with Call of Duty and such, whether you also see this integration with Xbox, with Azure and all these kinds of things. I'm really curious about that.
Yeah, it's exciting times, but the gaming industry is huge and growing. I think you touched on it. I think it's 200 billion, I think, at the moment, the industry, and only getting bigger and bigger. I think I read somewhere that over 3 billion people play games online right now. That's incredible, isn't it? So for Microsoft to tap into, I know they have with Xbox, but to tap into that even more now, I mean, they just seem to know all the right moves to make, don't they?
Yeah, definitely. Actually, before I bought ABBvie, I went down in my basement and asked my 16-year-old, because he knew a lot more about video games than I do. And then I keep asking him questions about how like they make those Call of Duties and like how they make their money and so on. So it was like a great chat about that. And then I realized, if there's one company that is able to bring video games to another level and that has the resources, obviously, that's definitely Microsoft. So, and I'm a Microsoft shareholder as well. So very happy about that trade. And interesting for those who listens today, there's still money to be made because the stock just went up to roughly $82 and the purchase price is at 95. So it's expecting to close next year in 2023. But I mean, it's still a good 15% potential, and at the same time the market's not going anywhere right now, so maybe it's a good way to save some money on the side.
Nice one. Yeah.
Nice. We might talk a little bit about Unilever then, because they've been in the news quite recently. I know you did a video on them, European EDGI, where they wanted to buy part of GSK spin-off.
Yeah, this was. I mean, what can I say? This was just too stupid to even consider. So, and then what is interesting right here is that let's Unilever got already in trouble over the summer with Ben and Jerry's and their ice creams in Israel and such, where you could clearly say that management of Unilever has nothing to say because Ben and Jerry said like, hey, here's our contract. You cannot deal with our business, Mr. Alan Yopi, CEO. We do whatever we want, and it's in our policy. I guess they have a very woke policy, let's say like that. So there was already some bad signs of what's happening to Unilever. We have, of course, the bid from 3G Capital not too long ago, 2-3 years ago, where Warren Buffett was sponsoring also the potential acquisition of Unilever, right? They said to shareholders, no, we don't want this. And they put some protection in place so that they're effectively also not really attractive to be acquired. But then they wanted to buy GSK for 50 billion pounds, right? And that was like a sales multiple of 7 or 8 for a consumer staple that is growing like few percent per year. And you know already that Unilever is not getting maximum out of their own business today, right? We either had the shareholder writing from was Fundsmith saying like, what's that they are redefining the purpose of their mayonnaise. Yeah, it sounds like a joke, but it's really an issue at the moment in Unilever. That's how they're thinking about the business. They're not focused on operational excellence as such. I mean, internally, they probably have some programs like every company, but they're not hitting the mark, nothing. And then they want to overpay for GSK assets. And what is important to know, GSK is doing a spin-off. So they're already thinking as a management, this is the real value. Of course, you don't underprice your spin-off already. And then Unilever wants to bid even more. It's like just mistake over mistake. You saw the share price reaction, I think, in the American market. It went down 15%. I think it was a clear signal. And then we got yesterday the news that the CEO said, well, we don't want to bid anything more. But it was already the third bid. And what even annoys me more, they only responded after GSK went public that they got an offer. Yeah, and this is really tricky because usually you would expect those companies to talk with each other or something like that. And Unilever sounded really surprised. So I think it's like that GSK kind of said to Unilever, screw you, we don't want you. We'll make it public and you figure it out.
I mean, the management team seem a bit lost, don't they? It looks like they've just lost control. And I think any credibility that they had left going into this is probably gone. I mean, I don't really know what they're trying to do with the company. The situation seems to be they'll just raise prices whenever they can, and they're not really looking at investments or what they can do, as you said, operational excellence to improve the actual company. And I think the pressure now is probably going to be too much for that CEO, Alan, to I can't see him lasting out the whole year. Yeah. The pressure is immense, particularly from institutional investors. They are beating that drum quite loud at the moment, aren't they? They're not happy.
Yeah, but only the hedge funds managers, because there are a lot of I don't know if it's, by the way, popular in Canada, but in Europe at the moment, ESG investing is kind of a criteria. Many countries are saying if it's not like having an ESG label, we cannot invest. So from that point of view, Unilever is really scoring all the points, right? And also what they did with the vegetarian butcher, they bought this kind of the Beyond Meat equivalent, really scaling it up. So they have assets and they have capabilities. They're just under managed, let's say. And remember, 55 years, no dividend cut, and just one time a 3% dividend cut since the Second World War. So from that point of view, it's an iconic company, right? And to see it being wasted by the current CEO so much, it's just painful as a dividend investor to see that.
And do you think that there's any possibility that they eventually do what Procter & Gamble did, which means that looking at their brand, trying to divest some and then optimize the whole thing? Because this operation was quite a success for Procter & Gamble. And I was looking at Unilever, and I see it as a potential because, so most of the time I'm not that interested in European stocks because I could find an equivalent that is easier to look at on my my side of the ocean. And then I was looking at Unilever, like with such an interesting yield versus a company like Procter and Gamble that has been doing well, but now offering like a 2% or something like that. So do you think that they could shift the business around that much, or they would need a new management to do that?
I think they need a new management. That's my opinion. On the other end, I bought few shares again because I actually like these kinds of periods. It frustrates me, right? But I like it because it allows you to accumulate. So every now and then when it dips, I get to buy some shares, build up my position at attractive yields, right? And I think this company is bigger than the CEO with its history. The issue they really have is now, for instance, P&G, I don't think they care too much about certain shrimps in a certain lake and or something like that, and whether it would harm the local ecosystem by Unilever being there or by them. And this kind of policy at the moment in Unilever, and it's really nice that they went from a shareholder to a stakeholder policy, but I think they struggle to find a profitable business behind it. I think they really believe, and to some extent I agree with it. If you do good for society, people will want to pay for it, right? But the moment they're just also being competitors to companies that are not living to those standards, like P&G. Yeah. And that's where they're losing just the game. And I think the question then is like, how much time do we have patience to see this turn into real profitability? And I think we're getting impatient here.
Yeah, but to answer your question, I do think that there will be divestments. Management have
announced that. Yeah,
they have said it already. They will do that. I expect the tea business to be, for example, that will surely be gone by the end of the year. But they are looking to divest, and they are working on high growth areas, which is what they always say. But I mean, where are these areas? And they have to figure that out quite quickly.
Yeah.
Okay. Good. I mean, two big pieces of news this week that moved the share prices quite quickly. I know a lot of people on Unilever, I think they dropped, was it 15% in one day? Managed to buy calls on that drop and profited after a day because it usually rebounds, which is quite good. But I think earnings is at the start of February, and I would expect it to either drop again after that, because it's not going to be pleasant, I don't think. Okay. So we might just ask you a few more questions, Mike, if that's okay.
For
maybe
sure.
A little bit more around dividend investing and so on. So I know you started in 2010 from buying the blog. So you can just talk a little bit then how you actually got into it. What was it, just from buying that blog then that you started dividend investing?
Yeah, so I was always invested 100% all the time, and 100% equities. So when I bought the blog, I just started to buy dividend paying stocks. And at first, like pretty much any investors, I started to have like some metrics that I was following, like PE ratio and payout ratio. Yeah. And I was automatically discarding any stocks paying under 3% of yield. That was like my minimum was 3%. And then I started with that. And after a few years, and especially like that was right after the financial crisis. So there were a lot of choices paying like 3-4%. That was a lot easier probably versus today, especially if you look at the US market. Now it's getting very hard to find a high quality company that is growing and is on top of that paying a 4% yield. Those are getting rare. So back then it was not that hard to find, but then I realized that a few great companies, amazing companies, were actually paying at 2.5%. And so I started to lower the level and eventually completely discard it and put dividend growth instead. So instead of looking at the yield, I was just looking at, okay, so if this company has at least increased its dividend for the past 5 years or 10 years, even better, and going forward. And I found that that was like the main factor when I was about to invest in a new stock. Looking at what eventually became what I call now the dividend triangle. So I look at 3 metrics and I look at the trends. So the first one is revenue, because I want a company like you were talking about, Unilever, that's having a hard time finding growth, and they're basically just following the inflation right now, and that's pretty much what's happening. So you want a company that goes a little bit faster than that. Microsoft would be a very good idea, double-digit revenue growth. And then I was looking at a company that would also generate profits, because it's one thing to generate revenue. In an ideal world, I would prefer to follow cash flow, but cash flow is usually hectic, so it's a little bit easier to follow earnings per share over a 5 years period, and any jumps or drop will just force me to go into those quarters and understand what's happening. But then I was looking at those trends, and that usually when you find a company that grow its revenue, grow its dividend, its earnings, it will eventually lead to dividend growth. And I've discovered that there was a lot of low yield, high growth stocks that could do both at the same time. So increase their dividend, but also generate some very interesting total return.
Yeah, I think this is typical. I think for people that are investing for longer, right? That we start to how you say it, feel the pains of failures that we made. And if you start looking back, the signs are clear that there was a revenue decline, or there was earnings decline, there was financial engineering. So what you're saying is really something I think that will give you a lot of success in the years to come, because effectively you have a nice screener for checking on very safe dividends here, unless of course something happens to the company, but you get then still so many warning signs and the opportunity to sell, let's say, compared to companies that are already struggling, like AT&T. We could see this coming, and then the spin-off. Yeah, and it shouldn't then come as a surprise, right? That it includes also implicitly a dividend cut.
Yeah, actually, it's kind of funny because we use that screener at Dividend Stocks Rocks as well. And then sometimes some members, they were just like, hey, how come you don't like this company or that company? They're paying a great yield. And I'm like, yeah, but if you look at the metrics and where the company's going, as you said, it's clear, like the path is going not towards the right direction.
Exactly.
You know, they used to increase their dividend by 5%, and now they went to 3 and to 2, and eventually that symbolic 1 cent of increase. And this is
That's
telling
killing.
you, it's something is going wrong here, and you have to ask questions now, especially right now. Anything that goes over 5% yield today has to come up with some risk at the same time. It's obvious.
Yeah, I think ABBvie is also a good example of that. I know it's really popular. It's also a high quality stock, but there's risk around it, right? With the biosimilars and such. And I think just they did an amazing acquisition of Allergen with the Botox producer.
Yeah, definitely.
But since then, also the price went up effectively, right? Before it was trading around $60, $70, and now it's under $30. And to your point, I think that's all the difference here, right? It mitigated the main risk there.
Yeah, especially now that we're entering into a market that investors are a little bit more nervous, and we don't know what's going to happen with inflation, and interest rates are going to go up. It's going to put some brakes on the economy. And if you want to skip a few drama and avoid some headaches, while having those sound companies, like I always say, you know what, today is always the best timing to invest. But the thing is, today you have to be pickier with your metrics and with your analysis. You have to go a little bit further in everywhere to make sure that maybe you're buying like very boring companies, but they are very solid as well. Because at one point or another, things are going to turn sour, and you want to make sure that those companies will continue to increase their dividend during those rough times.
Yeah, and do you, besides your initial screening, do you also kind of do maintenance on your portfolio, like revalidate those companies that you have in your portfolio, or is it kind of more like buy, hold, and kind of forget as well?
The idea is to buy and hold. However, I review my portfolio every quarter. So what I do is I make sure, and sometimes it's just a quick check. I mean, a company like Microsoft, whatever I do is, once I'm done doing the analysis, I will write down my investment thesis for any stocks I purchase. So that it really includes all the reason why I want to hold this company, but also all the potential downsides, because no company is perfect, and all of them will come with some risk. And every quarter, I will review my investment thesis, and I will review the quarter just to see, okay, if the company is going towards the same direction or not. So if they're having a bad quarter, that's not a big deal. But after 3 or 4 quarters that they're not going towards the right direction, and they're actually giving me strong signals that my investment thesis is wrong, or there's a shift in the environment that makes that now I'm not like the investment thesis doesn't work anymore, then I'm going to make a trade. So typically I'm going to, I don't know, trade like 2-3 times a year, not more than that.
Yeah.
Like this December, what I did is actually was more than tweaking most of my portfolio. I had like too large of an exposure to Apple and Microsoft. Combined together, they were like close to 25% of my entire portfolio. Didn't feel that comfortable at one point. So it's a good problem to have because they surged. So I sold a few shares, bought Activision Blizzard with it, and then bought some Canadian banks. Kind of funny because Activision Blizzard is going to come back to Microsoft, so now I have to sell it again. But I mean, that was the move that I made. But if not, I'm trying to buy those stocks and hopefully keep them forever. But unfortunately, sometimes companies are failing us.
Yeah, definitely.
It's quite hard, especially when you analyze every quarter. I know sometimes I don't know if it's FOMO is the right word, but sometimes you just feel like you have to sell something, or it kind of gets me in that time frame. So I prefer not to look at my portfolio every quarter. I do because I have a podcast and I have a blog, and it forces me to. But if I didn't have any of this stuff, I would probably just buy them and lock it away and forget, because sometimes I'm too tempted to do irrational things. Luckily, I have European EDGI there to talk to, and he'll talk some sense into me every now and again. But it's hard. It's really hard for investors, particularly with social media and all that. You have so many things coming at you.
Yeah,
it's hard not to jump onto the next best thing.
There's a lot of noise, but when I say that I review my stocks, I rarely review their performance. That is not something that I want to look at because, as you said, you go crazy. You look at the stocks and then you're down 20%. You're wondering if it's going to keep going down, or you're up 50% and you're just thinking, yeah, that's some good profit here. I should sell. But if I would have done that, I would have sold like Apple and Microsoft way before, which would have been a catastrophic trade, right? So it's just good to look at the reasons and not the impact. So it's never about, I never sell or buy because I'm making or losing money. That's not a good reason for me.
So what I did last year, I took the top 10 of my portfolio, which is I think half of the total portfolio as well. And I did just a financial analysis on them to see how safe the balance sheet is and everything. And that was very interesting. So I can tell you that with 9 out of them, I sleep well at night. So if there would now be a crash, I really wouldn't wake up from that. Only from ABBvie. There was like red flag after another with the debt, the solvency ratios. And even there, I feel good because it's an anti-cyclical industry. People will still need their drugs. They bought Allergen, so I had a feeling like this is just a matter of time and it will start to become amber and then quickly green already. But it was really insightful because it also gives peace in mind, right? If you know that you have top-notch quality like Microsoft, Apple, and also Unilever with just really good balance sheets, then why worry, right? Those are actually the stocks then that you want to double down on a market crash.
Yeah, definitely. Even like in March of 2020, when the market completely collapsed, I was looking at my companies and I was like, okay, so I have a telecom companies, which is TELUS in Canada. They are operating in an oligopoly. There are like three companies offering wireless services, and we will definitely need our cell phones. So this one is check. And then I had like some Canadian banks, but they are like the most well-capitalized banks in the world. They took their provision for credit losses, and yet they would still show payout ratios of like 55% after taking billions in provision for credit loss. So you're just like, okay, so they can afford to pay their dividend. Check, this one is good as well. And then we had some great utilities, companies that are like 100% regulated. I have like Fortis in my portfolio that has been paying and increasing its dividend for 48 consecutive years. So that's a lot of recession. That's a lot of like interest rate going up, going down, inflation, name it. And yet they have always been able to increase their dividends. So when you have companies like that, you mix it up with like some Apple and Microsoft, which like strong growth and also lots of cash flow. I didn't want to trade any of my stocks on those days. I was just, they're down, but I mean, the business is still growing very well. So that's not a problem.
Yeah, it's like the ultimate cash machine that you have created there.
Yeah.
And are those also then some of your favorite dividend stocks?
Yeah, definitely. Among my favorite one on the Canadian side, I'd say that Canadian banks are just amazing. We discussed that a little bit before we started recording. There's like 5 major banks in Canada, and there's a 6th one which is mostly operating in Quebec, which is National Bank. I used to work for them, so maybe this is why I love them so much. But they actually outperform the other big 5 for the past 20 years. So, and past 5 years, like you put pretty much any kind of dates there, and they've just been doing amazing. And one of their recipe of success was they used the classic savings and loans business model from banks, and then they decided to go after capital market. So they were making sure that the market is liquid, making the transaction between ETFs and stocks, for example. They went also big time with wealth management. So targeting like wealthier clients, like $1 million and up of investing assets. That was like quite a success. And then most recently, they started to go with more acquisitions. So they bought a bank in Cambodia, which was the largest bank in the country, which is kind of like similar of like their business model where they're a small bank, but they're dominating their market in the province of Quebec. Well, now they bought a small bank in Cambodia, but it's a big bank for that country. They did amazingly well. They went with EDGI. It's specialty finance credit in the US. So they have like all those other growth vectors on top of just saying, you know what, Canadians' economy is doing well. And that's one thing that's kind of funny, as opposed that we don't have that in US or in Europe, is there's a lot of regulation around banks. So it's not that because Canadian banks are smarter. It's just that they're not allowed to do like subprime mortgages and stuff like that. They were just not allowed to take that amount of risk. So sometimes investors are just like, yeah, Canadian banks, they're like too boring. They don't want to take enough risk. They don't bring in enough growth. But then when you look back, you just realize that they're making money year after year, and it's just increasing, and they're increasing their dividend accordingly, and they're incredibly solid. So that's pretty much the secret of their success. And a great oligopoly, strongly regulated by the government. So that makes them very strong and
It's
almost
kind of a utility.
Yeah, it is. It's really, it's like that, but with less capex, like less like billions of dollars that you have to invest everywhere, and probably like a little bit more growth perspective because of that.
Yeah, nice. I would argue in Europe, by the way, we also have a lot of regulation, but I believe there's a reason why all those banks are having fine after fine after fine, because they just don't respect the regulations.